welcome. You are watching Business Plus here on News9 Live. I'm Krishnakumar, and joining me in the studios for the afternoon edition of Business Plus is my colleague and friend Suyash Maheshwari. And as always, we begin the afternoon edition with a check of how India's stock markets closed the day's trading session. Suyash, talk to us. Markets opening flattish, but not really having a good trading session after that.
Not having a good day at all, Krishna. The markets collapsed and they crashed by about 1% in today's trade. Now, some volatility was expected given that today was a futures and options monthly expiry, but this kind of crash was not something that the market was expecting. But given the global cues, then again, we can't really say, how the markets will perform. Now, in today's session, at close, Sensex was down about 600 points or so. It managed to close just above the 65,508 mark, whereas Nifty not only, fell below 19,700, 19,600, it even briefly fell below 19,500. But we saw some recovery in the last 15-20 minutes or so, and the index managed to close above the 19,500 mark, down about 0.98% in today's trade. Now, if you look at the broader markets, Krishna, the broader markets which were largely mixed in today's morning trade also succumbed to selling pressure. In fact, Nifty mid cap 100 was down about 1.32% or so at close, whereas small cap index was down about 0.41% or thereabouts. And as I said, today was a weekly expiry. As a result, we saw a spike in volatility and
clearly the India volatility index up nearly 11%.
Nearly 11% and above the 12 mark, which suggests that the volatility has increased significantly compared to the last 30 days or so.
Right, and this is what you call as archetypically a sea of red as far as India stock markets. It's red all over the place. Broader markets, Nifty, Sensex, Nifty mid cap, small cap. There is no place to hide in these markets, is there? Is there a defensive play in these markets on a day like this?
I mean, if you're looking at the sectors, all of them ended with major losses.
Okay.
In fact, the banking pack, which was actually underperforming markets the entire past week, managed to outperform market. It was also down. It was down. The Nifty banking index was down about 0.64% in today's trade. The IT pack, Krishna, was a worst hit. It fell over 2% in today's trade. Now, among sectoral indices which fell over 1% is Nifty Auto. It was down about 1.17%. The FMCG pack, which again almost fell 2%, it was down 1.91% in today's trade. As I mentioned, IT pack was a worst performer. It was down about 2.19% in today's trade. The media pack fell about 1.4%. Metals corrected by 0.96%. Pharma PSUs also fell about 1% in today's trade, Krishna.
Right, that's the roundup of the day's trading session with Suyash. Suyash, of course, is going to stay on with us because we have a very special market guest joining us live on the show. We have Shahina Mukadam joining us live on Business Plus. Shahina, thank you so much for taking time out to be with us here on News9 Live. What a day to join us for the first time. It's a sea of red on Dalal Street for the day.
Well, yes, and the thing is, we are at very important support levels. So and also being the last day of the expiry, so I think a lot of things came together for us today. But I do think that if we are able to sustain above these levels, then we may again see some bit of recovery going into next week. Because actually the stocks and the sectors that we saw today that actually pulled down the market were largely the defensive sectors, as we were discussing. The IT, you have FMCG, and some of the engineering and I would say some telecom companies did well. So to that extent, let us hope that there is support that comes over the next week.
As you mentioned, ma'am, the markets have been under pressure and perhaps support will emerge. What's keeping the markets down? Why did we see a 1% correction today?
Well, there are a number of factors. Actually, if you see the oil prices, crude oil prices, in closer to 3 digits is a very big, I would say, negative for the overall market. Now, this is over and above the other issues that are plaguing the, the global, as you know, there is a war going on, Russia, Ukraine. Also, there is an issue in terms of demand in Europe. Most of the companies which are having their markets, international markets of Europe and US, are facing some bit of slowdown. Also, in the domestic market, given inflation that has actually is remaining on the upper side and expected may slip further up, is keeping a pressure on demand even in rural areas. Petrol diesel prices are at a very high level, raw material costs are going up, so to that extent, all these things have come together in the very shorter term, which is why we've seen this correction. Not to say that the markets were cheap, so it's like markets also were expensive, so
Right.
given this fact, we've seen this sort of correction.
Right, and especially, I mean, a lot of talk about how some mid-cap and small-cap stocks, have sort of have become overheated simply because of the buying interest that's been witnessed in them in the recent past.
Yeah, so if you see the mid cap in the last 1 year was up by 35%. And if you compare this with the large caps, it was 15%. I mean, this is not to say that this sort of outperformance is, normally mid caps will outperform large caps, but if you see the last 2 years trend, this rally has been it has been much faster than what was anticipated, and the valuations for, the mid cap stocks, there's a small basket of mid cap stocks, especially which institutions can, subscribe to and have in part of their portfolio. So those valuations have become pretty stretched. Like for the first time, it's becoming difficult to actually look and identify stocks which look reasonably attractive in terms of valuation, which looks okay in terms of business prospects. I'm talking over the next, say, 6 months to 1 year. So it's becoming a bit difficult to find such stocks, and the stocks that have moved up are seeing some bit of profit booking.
All right, all right. Shahina, stay with us. Interesting point of view coming in over there. Are we looking at this 1% correction too intently? Because let's face it, we are in the midst of overheated markets. Corrections and consolidation was always going to happen, wasn't it, Suyash?
And corrections and consolidations definitely needed to happen in the markets, which we saw a surge of in Nifty, we saw a surge of about 1,000 points in a matter of 7 days. So as you rightly pointed out, correction was something that the markets was really hoping for, and consolidation was something that we're hoping for. And if we talk about the mid cap and the small cap space, Krishna, we are seeing that the participation has dropped down substantially. The number of stocks that were participating in the rally, the overall breadth has reduced. Not too many mid caps and the small caps stocks are participating. In fact, Shahina, I was looking at the trend in the mid cap and the small cap basket, and I was seeing, at least as per my analysis, there seems to be some sort of a divergence that is also playing out between the mid cap and the small caps. The mid caps have been underperforming in the past few sessions, whereas the small cap index has largely beaten the market. Do you see this divergence playing out?
Well, see, the small cap is always a very interesting space to be in. And what I have seen in my long career in the markets is that the most money is actually made in small caps, provided you've got your small caps correct. So this is a very difficult thing for retail investors to do, because unless you know what you're investing in, the company, the management, the integrity, the size of market, you can get very badly hit, and your small cap can just become a penny stock. So to that extent, if you get if it's correct, then yes, small caps do outperform, but it's a very, very risky part of your portfolio. And I think mid caps is the space where normally, you can make decent amount of money, and which is where the retail investors in the last 1 year did come in full force. And even I would say institutions did, add on to the portfolios in mid caps. But now the rally has actually started, I would say, consolidating, because the stocks have moved up and the valuations have become, a bit expensive.
So perhaps time to once again look at the large caps, would you say?
I would say that large caps always has to be part of your portfolio. I mean, you cannot overlook the fact that while they may give you 10 to 15% return over 1 to 2 years, they are the liquid stocks. So if you are having investments, which when you have investments because you need the money sometime and you would like to have liquid investments. So to that extent, it is a must to have them. Only it keeps changing. Like year by year, the large caps which need to be in your portfolio may change. So I'm not saying you buy your large cap and keep it forever, though some you may. They may be portfolio stocks. Like for example, now you have L&T which is doing well, which is the large cap, which really didn't do well for quite some time. So there is a churn that takes place in large caps. Mid caps is something that you should invest in and then hold it for 2 to 3 years at least to get decent amount of returns. So to that extent, as of now, yes, large cap does look like the place to be in.
Now, Shahina, a lot of cues that you also mentioned earlier in the conversation, they all seem to be global cues. Any earning season is going to kickstart in a couple of weeks. What are your broader expectations from India Inc.'s Q2 report card?
Well, I'm not expecting too much. Couple of reasons. One of the large sectors like IT, while we're not expecting some very bad numbers, but in fact we are expecting it to bottom out in this quarter. So IT is not going to be something where you get very excited about by seeing the numbers. Then oil and gas. Oil and gas, you see the crude oil prices. So this sector also is not likely to give you a very healthy sort of number in times of like stuff like OMCs. Also, you have elections that are going to come now. So to that extent, some of the agri product companies which are targeting the rural markets, there also you may see limited scope for price increases, or they would have to absorb some of the raw material price increases. Metals also. I mean, on a YOY basis, you cannot expect any substantial, great numbers. So I think overall, this quarter numbers is likely to be subdued, and the overall market is reflecting that. So I think the market for the next couple of months, maybe 3 months, quarter or so, will be in a mode of consolidation. So we should be happy if we remain between the 19,500 and 2,000 levels.
All right, consolidation mode. Fair enough. Clear call coming in over there for the next 3 months. Earnings, don't expect too much from corporate earnings. That's the call as far as broader markets are concerned. Suyash, we want to discuss the IT pack as well. But before we do that, let's just quickly get back to the day's trading session as well and talk about the big gainers and losers in the day's trading session.
Certainly, Krishna. So among the top gainers in the blue chip pack was Larsen & Toubro. Now, Larsen & Toubro touched a record high level. It broke past the 3,000 mark. Now, the trigger for the stock today was that UBS has raised a target price on the stock from about 3,040 to 3,600 rupees, which implies an upside of about 20% or so from today's closing. So that was a major trigger for the stock. And even if you see, the stock has been one of the outperformers this year. It has rallied about 44% year to date. In fact, in the last month or so, it has rallied about 10% or so. And its share buyback plan, which kicked in earlier this week, was also fully subscribed. They are buying back about 10,000 shares or so from the market, and it was fully subscribed. We saw good retail participation. So L&T is one of the stock that has been trending upwards slowly and steadily. Now, Bharti Airtel was another stock that was in the news today, and in fact it was among the top gainers. Bharti Airtel rose about 1.17% in today's trade. Now, this was on the back of Bharti Airtel adding 15.2 lakh new users in July compared to 14.1 lakh users back in June. Now, another gainer was ONGC. The stock was up 0.5%, and we are seeing in today's session we saw a rally in most oil stocks. ONGC was one, HPCL was another one. Now, this was on the back of a surge in crude prices, which bodes well for upstream company as it improves their revenue guidance and profitability visibility.
Right.
Now, another stock was Coal India. Coal India was up about 0.46%. The stock is at a near a 6 or 7 year high currently. Power Grid Corporation also gained about 0.4%. This was on the back of expectations that the stock will get a lot of passive flows since NSE rejig is to take place today, and expectation is that Power Grid Corporation will see a lot of passive inflows from the stock. Now, among losers, Krishna, was Tech Mahindra. Tech Mahindra was down about 4% in today's trade. Now, as we were talking about, IT pack overall came under pressure, but Tech Mahindra was took the worst hit. The stock was down, and in fact, if you look at the past 5-6 days, the stock has been on a run up. In fact, today it broke a 4-day winning streak, so perhaps we are seeing some sort of a profit booking taking place there. Another stock which was down today was Asian Paints. Asian Paints fell over 3.5%. Now, this was on the back of surge in crude prices, which is a major raw material for most paint companies. LTI Mindtree fell about 3%. Mahindra and Mahindra saw some profit booking taking place. It was down 2%. Wipro was also down 2% in today's trade.
Right. Both the Mahindra stocks, M&M and Tech Mahindra, they have run up in the recent past, and consolidation or profit booking, you would say, in both the Mahindra stocks, Suyash.
Exactly, that's what's playing out, Krishna, because the stocks were rallying at least in the past month or so. Mahindra and Mahindra, as we are seeing, there's some pressure because of the FIR that was filed, and Tech Mahindra also stock which was seeing a bit of a run up has also seen some profit booking taking place. But the the trend that we are picking up today is that most IT stocks saw some correction.
Absolutely.
And it seems that the view is largely divided on the IT pack.
Then takes us back to Shahina. Then a very good point. That's Suyash. We've been talking about Shahina. Look at the day's trading session. That's emblematic of what's been happening with the IT pack. You have the biggest loser, that's Tech Mahindra. You also have Wipro. Tell us, your own view of what exactly is happening with these IT stocks.
Well, see, most of the large IT stocks have over 50% of their revenues coming in from US market actually. And if you see what is happening in the US market is that, and largely BFSI. Largely, there is a slowdown both in terms of the deals that these companies are signing, as well as a large part of the hiring or new orders, they're doing it locally, in the US market. So there is a bit of a slowdown in overall growth for the large IT companies. Also, the margins have seen a bit of a dip, and some of the large IT companies, like for example, Infosys, they have been actually bringing down their guidance quite substantially, and the growth for this year, this full FY24, is expected to be subdued because of all these reasons. So to that extent, the overall IT, which I would say should be part of your long-term portfolio, is seeing has actually not been part of many funds. It's not been a large part of their portfolio as of now. So to that extent, they may use this opportunity for the next couple of months to slowly chip in and buy some of IT stocks and some of the large ones, not expecting anything major in terms of earnings for the next couple of quarters. So to that extent, I think retail also can start buying slowly some of the large IT companies, because they are definitely good companies to hold in your long-term portfolio. But you don't need to rush in and buy now. You have all the time in the world. Take the next couple of months and add.
All right, Suyash, isn't it interesting, isn't it? The entire sea of red accounts, all sectors. IT pack only is the only sector that is down more than 2%. All of the sectors are down anywhere from 0.5% to 1.5%, 1%. But IT pack is the biggest of all losers even today.
Yes, and as Shahina also pointed out, that a lot of revenue that these companies generate comes from US, and we are seeing a turmoil brewing in the US economy. In fact, JP Morgan CEO Jamie Dimon recently said that US could be facing a stagflation sort of a situation.
Right.
We are hearing talks about a government shutdown in the US.
Right.
So a lot of headwinds for the global markets, especially for the US and European markets, given that interest rate regime is also expected to stay. Interest rates are expected to stay higher for longer, and perhaps we can see another rate hike coming in November. So a lot of pressure building in the global market, especially for the US, China, and other European stocks. Now, talking about stocks, Shahina, L&T is one that has outperformed, has exceeded market expectations. Largely, the stock was also up about 2% or so in today's trade on the buy call from after UBS raised the target price. How do you see the stock after the recent run up? Would you still recommend perhaps adding position in the stock?
Well, I think I would prefer for it to cool down a bit, because the 3,200 the buyback price, I mean, it closed on September 25th, recent. So to that extent, this rally has, of course, to an extent been on back of that. Not to say that the sector is back in limelight, because of course L&T has got huge orders in its order book position is good. They're doing well both in the Middle East markets as well as domestic. The order pipeline is strong. So to that extent, it's a good buy. But at the same time, if you're a new investor and you're looking to buy L&T, I would just wait for maybe a week or two, let the market overall settle down for L&T after the buyback, and then you can look to add it to your portfolio.
Another stock I wanted to touch on was Vedanta. Now, Vedanta outperformed the market today. In fact, it ended in green with about gains of 0.5%. In the morning trade, it was up 1%. Now, this rise came on the back of news that Vedanta could be looking at demerging some of its business into several listed entities. Now the stock is currently trading near its 14-month low or so. It has taken a beating, considering that the debt concerns relating to the company have been mounting. In fact, Moody's also downgraded the corporate family rating of Vedanta Resources, which is the parent company of Vedanta, yesterday. So what's your overall outlook on the stock? Can we expect some sort of a bounce back, given that the stock has corrected about 40% or so in a matter of few months?
I would classify Vedanta as a very high risk stock. I used to have a very negative call on the stock, and I still, wouldn't really recommend anyone to go and buy Vedanta, despite it having corrected. It is less to do with the business in terms of the opportunity. They are in oil, they are in zinc, they are in aluminium. So everything is doing well. But if you see the debt in the company, and you see the way the management has been continuously changing its strategy vis-a-vis India, once it's okay, we want to deal with this company and this business, and then this we will fund the debt from this, and the dividend that they pay is high, but it is basically eating into instead of repaying the debt, it's dividend. So to that extent, I would just stay away from Vedanta, though I think it's come off a lot. So if you are a very high risk trader, you can look at the technicals and trade.
High risk people only is the word coming in from Shahina Mukadam. Shahina, we can continue chatting on so many of these stocks and getting your perspectives, but I'm afraid we are running out of time here on the show. We have so much else to cover as well. But for now, thank you so much for taking time out to be with us here on Business Plus. Hope to keep having you on the show as often as possible going forward. But for now, we'll let go of you. And of course, Suyash, thank you so much as always for putting the day's market action and the situation that markets find themselves in into perspective.